everyone, let's continue with the journal entries. We are just left for the journal entries and some other important points before we wind up the session for amalgamation. So yeah, let's continue. So journal entries to close the books of the vendor company because there is no more no company which is still existing now. I have to close the books, right? That's what we will understand the journal entries here. In the case of amalgamation on any of the two methods, there shall be an accounting treatment both in the books of vendor and the vendee companies. Since the books of the vendor will be closed upon amalgamation, the liabilities at the book value are transferred to a separate account called as realization. All assets and liabilities will be, or all assets and liabilities, or assets which are transferred and liabilities which are transferred will be now taken to a separate account known as realization account. I'm going to realize right now. That's why it is realization account. The purchase consideration receivable is credited to the realization account. I've bought all the assets and liabilities. Now for this, I'm going to receive a consideration. That also I'm going to bring into realization account. On the receipt of the purchase consideration, it is debited to the equity shareholders and preference shareholders account. The balance of the realization account is transferred to the equity shareholders account. Okay. On the receipt of the purchase consideration, it is debited to the equity shareholders in preference shareholders account. The balance of the realization account is transferred to the equity shareholders account. Anything balance is transferred to the equity shareholders account. Because it's a liabilities are not taken over by the vendor company but settled by the vendor company as shown in the books of account in the vendor books only. Open realization account and transfer all these at book value. All this at book value. Okay. Exception. What is an exception? If a cash is not taken over by the purchasing company, it should not be transferred. If cash is also taken over, then it will be transferred. If it is not taken over, then it will not be transferred. Note, profit and loss account debit balance and expense not written off are not assets and should not be transferred to realization account. If there is a debit balance in the profit and loss account is shown wrongly in the asset side, that should not be taken. Also, expense that is not preliminary expenses written not written off, those will be there, right? That will also not be taken as asset which is not transferred basically to the realization account. Transfer account, the liabilities which the purchasing company is to take over. In the case of merger, all liabilities will be taken over, right? So all liabilities will be transferred. In the case of purchase, well, some liabilities will be taken over, that alone will be transferred. In case of the provisions, the portion which represents a liability expected to arise in the future should be so transferred. The portion which is not required should be treated as profit. For liabilities not taken over, purchasing company, the profit or loss on discharge of liability should be transferred to the realization account. Debit the purchasing company and credit the realization account with the purchase consideration. On the receipt of purchase consideration, debit what is received and credit the purchasing company. So I'm going to create first what? Create a receivable entry that is known as purchasing company debit. He's like a debtor right now. So purchasing company debit and credit the realization account with the purchase consideration. Once it is received, I'll put all the assets receivable cash or shares or that and credit the purchasing company. So purchasing company will account will be now closed. Expense of liquidation. Expenses of liquidation have to be dealt according to each case. Like the case on case basis differs. What could be the cases if the vendor company has to bear and pay? Okay, then realization account should be debited and cash account should be credited. Okay, if the expenses are to be borne by the purchasing company, the question may be dealt within one of the two ways as may be mentioned. It may be ignored in the books of the vendor company. If expenses are to be paid first by the vendor company and afterwards reimbursed by the purchasing company, the following two entries will be passed. See, either if it is entirely paid by the purchasing company, then I can ignore in the books of the vendor company. But if I'm going to pay it first and then get it reimbursed from the purchasing company, then this entry will have to be passed. Debit what? This is like a return now, right? Purchasing company debit to credit the cash account when the expenses are paid by the vendor company. Debit cash account, credit the purchasing company account, reverse entry when the cash is being reimbursed. Liabilities not assumed by the purchasing company have to be paid off. I'm not going to take over some liability, then that has to be paid off by the vendor company. On payment, thereby the liability consulted of the cash. Any difference between the amount actually paid and the book figure must be transferred to where? Realization account. Because the account entire books of the vendor company is now to be closed, right? Credit the preference shareholders with the amount payable to them and debiting the preference share capital with the amount shown in the books, transferring the difference between two to the realization account. I've now closed the close and settle the preference share capital, right? So now I could debit the preference share capital and credit the preference shareholder individually. And what I will do, if there is any difference between the book value and the settlement price, that will be transferred to the realization account. In the absence of any indication to the contrary, preference shareholder will be entitled only to the capital contributed by them. But if the funds are available after paying of the creditors are not sufficient to satisfy the claim of the preference shareholders fully, they will suffer a loss to the extent of that deficit. They will suffer the loss in the case there is a deficit. Pay off preference shareholders by debiting them and crediting whatever is given to them. Preference shareholder account debit to whatever is given out, either it can be cash or shares of the transferee company, whatever it may be, it has to be credited. Transfer the equity capital and amount representing the profit to equity shareholders account. This will determine the amount receivable by the equity shareholders. On satisfaction of the claims, the equity shareholders debit their account and credit whatever is given to them. With this, every account will be closed now when the books of the vendor company successfully closed. Okay, it's very easy, right? I have to close all the accounts now. Simple. Let's move on. Entry in the books of purchasing company. In the books of purchasing company, the assets and liabilities are taken over are recorded at the agreed value, and where there is no agreed value, then it is book value. Okay. In the case of merger, it is only book value. For in the case of purchase, it will either be an agreed value or a book value. Debit the business purchase account and credit the liquidator of the vendor company with the account of purchase consideration. Okay. Debit the business purchase account and credit the liquidator of the vendor company with the account of with the amount of purchase consideration. Debit assets acquired at the value placed by the purchasing company. Credit the liabilities taken over an agreed value and credit the business purchase account with the amount of purchase consideration. And if the credit exceeds the debit, the difference should be taken as goodwill. If the reverse case, then it should be taken as capital reserve. On the payment to the vendor company, the balance the entry to be made for the payment of cash or issue of shares in satisfaction of the purchase consideration. If the purchasing company is required to pay the expenses of liquidation to the vendor company, the expense should be debited to goodwill or capital reserve account as the case. If there is a goodwill, then I have to debit again with that amount also. And if there is a capital reserve, I have to reduce the capital reserve to that extent. Okay, this is also very simple, right? I have to bring all the assets and liabilities. And then if there is any shortage in debit, then it will be taken as goodwill. Shortage in credit, then less capital reserve. Any adjustment in the case of closing, winding up expenses will be adjusted against a goodwill or capital reserve. Clear? Great. Now, the last. Typical adjustments which shall be noted while working out the problems. It's a very important adjustments. So, intercompany owing. If the purchasing company owe an amount to the vendor company or vice versa, the amount will be included in the books debts of the one company and trade payables of the other should be adjusted. So, I have to close that entry. Okay, the entry should be made after the usual acquisition entry have been passed. This should be made after the usual acquisition entry have been passed. At the time of preparing the realization account, passing the business purchase entry, no attention need to be paid to the fact that two companies involved money mutually. Okay, see, till the time I bring in the all the accounts of the transferor company, the books of the transferee company, I should not even think about these two accounts. Once it is brought, now both the debit and credit will be there in the one book, right? Now it has to be netted off. Okay, closed. Now, adjustment of the value of the stock. Intercompany owing arise usually from the purchase or sale of goods. It is likely, therefore, that the time of sale of business, the data company also has a good stock which is purchased from the creditor company. The cost of the data company will include the profit made by the creditor company. After the takeover of the business, it is essential to eliminate this unrealized profit. The entry for this will be made by the purchasing company only. Okay, if it's the vendor company which has sold the stocks at the time of passing the acquisition entry, the value of the stock should be reduced to the cost of the company which is acquiring to the business. Automatically, goodwill or capital reserve will be adjusted. But if the original sale was made by the vendor company and the stock was within the company of the acquiring business, the latter company will have to debit the goodwill and credit the stock with the amount of profit included in the stock. Okay, see, well, for stock adjustments, when where the amount will be there, it will be adjusted against the goodwill or capital reserve. So simple like that. Okay, just remember like this. Okay. Now, intercompany loan. Where there is any loan taken by the transferor company from the transferee company, then the amount of loan shall be taken over by the transferee company adjustment entry. Same like what we had for trade receivable and trade payable. Similar entry will be passed. For loans also. So with this, all the important points in amalgamation topic have been discussed. So stay tuned for some discussion. Thank you.